Hello and welcome back to Money Mastermind. Today we are exploring the stock market for beginners. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now let's get straight into it. The stock market serves as the foundation of the global economy, representing a platform where investors buy and sell shares of publicly traded companies. Fundamentally, the stock market functions as a marketplace where ownership stakes in businesses are exchanged, facilitating capital formation and investment opportunities. For those venturing into the world of investing, understanding the stock market is critical. Understanding key concepts such as stock prices, market trends, and risk factors enables you to make informed decisions, mitigating the inherent uncertainties associated with investing. Also, familiarity with the stock market encourages confidence and allows individuals to actively participate in wealth-building activities. Whether aiming to secure retirement funds, save for major expenses, or generate passive income, a foundational knowledge of the stock market equips you with the tools needed to begin your investment journey with clarity and purpose. In its simplest form, the stock market represents a marketplace where shares of ownership in companies are bought and sold. Each share represents a fractional ownership interest in a company, entitling the shareholder to a portion of the company's profits and assets. Investors purchase stocks with the expectation of realizing capital gains through price appreciation or dividends paid by the company. Key concepts in the stock market include stocks, which are ownership stakes in companies, stock exchanges where trading occurs, and stock indices such as the S&P 500 or Dow Jones Industrial Average, which track the performance of specific segments of the market. The stock market serves several essential functions within the economy. Firstly, it promotes capital formation by enabling companies to raise funds for expansion, research, and development through the issuance of stocks. Secondly, it provides liquidity, allowing you to easily buy and sell securities, thereby ensuring efficient price discovery. The stock market also serves as a measure of economic health, understanding market perception, and economic trends through changes in stock prices. Various roles participate in the stock market, including individual investors, institutional investors, such as mutual funds and pension funds, stockbrokers, investment bankers, and market makers. Each participant plays a unique role in driving market activity and influencing price movements, contributing to the liquidity of the stock market. The stock market contains two primary components: primary market and the secondary market. In the primary market, companies issue new shares of stock to raise capital through initial public offerings, IPOs, or subsequent offerings. These newly issued shares are sold directly to investors, often facilitated by investment banks or underwriters. Conversely, the secondary market encompasses the trading of existing shares among investors. Here, stocks are bought and sold on stock exchanges or over-the-counter platforms, allowing investors to trade securities among themselves. The secondary market provides liquidity to investors by enabling them to easily buy and sell shares, thereby influencing stock prices based on supply and demand dynamics. You can buy and sell stocks through brokerage accounts, either online or through traditional brokerage firms. To purchase stocks, you place buy orders specifying the quantity and price at which you are willing to buy. Conversely, when selling stocks, you place sell orders indicating the quantity and desired selling price. Transactions are executed when buy and sell orders match, with stock exchanges or brokers enabling the trade. Stock prices are influenced by several factors, including company-specific fundamentals, economic indicators, market perspective, and geopolitical events. Also, broader economic factors such as interest rates, inflation, and GDP growth can influence market perception and market valuations. One of the primary reasons investors use the stock market is its potential for generating high returns. Historically, stocks have outperformed other asset classes over the long term, providing investors with significant capital appreciation. While stock market returns are not guaranteed and can fluctuate over the short term, investing in a diversified portfolio of stocks can yield substantial returns over time, helping you build wealth and secure your financial future. Another compelling reason to invest in the stock market is the diversification benefits it offers. By spreading investment capital across a variety of stocks, sectors, and asset classes, you can reduce the overall risk of their portfolio. Diversification helps mitigate the impact of individual stock price movements and sector-specific risks, thereby enhancing portfolio stability and resilience. Investing in international stocks can further diversify risk and provide exposure to global economic growth opportunities. Also, investing in stocks serves as a hedge against inflation, preserving the purchasing power of investment capital over time. Unlike fixed income investments such as bonds or savings accounts, which may struggle to keep pace with inflation, stocks have the potential to generate returns that exceed the rate of inflation. As companies generate profits and grow their earnings, over time, stock prices tend to rise, providing you with a means to preserve and grow your wealth during inflation. In summary, investing in the stock market offers numerous advantages, including the potential for high returns, diversification benefits, and protection against inflation. While investing in stocks entails risks, wise investment strategies and a long-term perspective can help you use the full potential of the stock market to achieve your financial goals. Stocks come in various types, each with its own characteristics and investment considerations. Understanding the distinctions between different types of stocks is essential for those seeking to construct a diversified portfolio tailored to their investment objectives and risk tolerance. Common stocks and preferred stocks represent two primary categories of equity ownership in companies. Common stocks entitle shareholders to voting rights and participation in company profits through dividends and capital appreciation. Preferred stocks, on the other hand, typically offer fixed dividend payments and priority over common stockholders in the event of company liquidation. While common stocks generally offer greater potential for capital appreciation, preferred stocks appeal to investors seeking income stability and preferential treatment in dividend payments. Growth stocks and value stocks represent distinct investment styles based on different criteria for evaluating company fundamentals. Growth stocks are characterized by companies experiencing rapid earnings growth and expansion, often trading at high price-to-earnings ratios relative to their earnings. Investors in growth stocks are betting on the company's future growth potential, willing to pay a premium for anticipated earnings growth. In contrast, value stocks are undervalued relative to their intrinsic worth, trading at low price-to-earnings ratios or below book value. Value investors seek stocks with strong fundamentals and attractive valuations, anticipating price appreciation as market perceptions align with intrinsic value. Blue chip stocks and penny stocks represent contrasting ends of the stock market spectrum in terms of company size, stability, and investment risk. Blue chip stocks refer to shares of large established companies with strong track records of performance, stability, and market leadership. These companies typically have recognizable brand names, diversified revenue streams, and a history of paying dividends. In contrast, penny stocks are characterized by low market capitalization and share prices, often trading for less than $1 per share. Penny stocks are associated with higher volatility and speculative risk, as they may lack liquidity, transparency, and regulatory oversight compared to larger, more established companies. By understanding the different types of stocks available in the market, you can tailor your investment strategies to align with your financial goals, risk tolerance, and time horizon, thereby optimizing your portfolio's performance and diversification. Investing in the stock market offers the potential for substantial returns, but it also entails inherent risks that you must be aware of and manage effectively. Understanding the various risks associated with stock market investing is crucial for making informed investment decisions and safeguarding one's financial assets. Market risk, also known as systematic risk, refers to the inherent volatility and uncertainty of the overall stock market. Factors such as economic cycles, interest rate fluctuations, and geopolitical events can impact market outlook and lead to broad-based fluctuations in stock prices. Market risk affects all investments to some degree and cannot be diversified away. However, you can mitigate market risk through diversification across different asset classes and sectors, as well as maintaining a long-term investment horizon to weather short-term market fluctuations. Company-specific risk, also known as unsystematic risk, arises from factors specific to individual companies or industries. Examples of company-specific risks include poor management decisions, competitive pressures, product recalls, and legal or regulatory issues. Unlike market risk, company-specific risk can be diversified away by investing in a diversified portfolio of stocks across different industries and sectors. Conducting thorough research and due diligence on individual companies can help you identify and mitigate company-specific risks before making investment decisions. Economic and geopolitical risks encompass a wide range of external factors that can impact the stock market's performance. Economic risks include factors such as inflation, unemployment, and policy changes, which can influence investor sentiment and market valuations. Geopolitical risks arise from events such as wars, terrorism, trade tensions, and political instability, which can disrupt global markets and undermine your confidence. While economic and geopolitical risks are difficult to predict, you can mitigate their impact by staying informed about global developments, maintaining a diversified portfolio, and adopting a long-term investment approach. Diving into the stock market requires careful planning and preparation. From defining investment goals to selecting suitable stocks, you must follow a systematic approach to enter the market with confidence and clarity. The first step in getting started in the stock market is to define clear and achievable investment goals. You should assess your financial objectives, time horizon, and risk tolerance to determine your investment strategy. Whether the goal is wealth accumulation, retirement planning, or saving for a major expense, having a well-defined investment plan serves as a roadmap for guiding investment decisions and measuring success. Once investment goals are established, you need to open a brokerage account to begin stock trading. Brokerage accounts provide access to stock exchanges and allow you to buy and sell stocks online or through traditional brokerage firms. When choosing a brokerage account, you should consider factors such as fees, commissions, trading platforms, research tools, and customer support. Opening a brokerage account is a straightforward process that typically requires providing personal information, funding the account, and completing account setup procedures. Researching and selecting stocks is a critical aspect of stock market investing. You should conduct thorough research on individual companies, analyzing their financial performance, business models, competitive advantages, and growth prospects. Also, you should consider factors such as industry trends, market conditions, and valuation metrics when evaluating potential stocks. While there are various approaches to stock selection, including fundamental analysis, technical analysis, and quantitative analysis, you should focus on building a diversified portfolio of high-quality stocks that align with your investment goals and risk tolerance. By following these steps and taking a disciplined approach to stock market investing, you can lay the foundation for a successful investment journey. With proper planning, research, and execution, you can navigate the stock market with confidence and work towards achieving your financial goals. Navigating the stock market as a beginner can be daunting, but implementing sound investment strategies can help mitigate risks and maximize returns over the long term. Here are 3 effective investment strategies tailored for beginners. Dollar cost averaging is a disciplined investment approach that involves investing a fixed amount of money at regular intervals, regardless of market conditions. By spreading investments over time, you can benefit from averaging out the purchase price of stocks, mitigating the impact of market volatility. This strategy helps you avoid the pitfalls of trying to time the market and reduces the risk of investing a large sum of money at a poor time. Dollar cost averaging is particularly well suited for beginners who are looking to build wealth steadily over time while minimizing the emotional impact of market fluctuations. The buy and hold strategy is a long-term investment approach based on the belief that holding on to quality stocks for extended periods yields superior returns. Instead of trying to time the market or engage in frequent trading, you should identify fundamentally strong companies with solid growth potential and hold onto your investments through market ups and downs. This strategy emphasizes patience, discipline, and a focus on the intrinsic value of stocks rather than short-term price movements. For beginners, the buy and hold strategy offers simplicity and the opportunity to benefit from the power of compounding returns over time. Diversification is a fundamental principle of investing that involves spreading investment capital across a variety of asset classes, sectors, and geographic regions to reduce portfolio risk. By not putting all your eggs in one basket, you can minimize the impact of any single investment's poor performance on your overall portfolio. Diversification can be achieved through investing in a mix of stocks, bonds, mutual funds, exchange-traded funds, and other assets. For beginners, diversification provides a smart and simple way to manage risk while capturing the potential upside of different market segments. By implementing these investment strategies, you can build a solid foundation for long-term wealth accumulation and financial success in the stock market. Each strategy offers unique benefits and considerations, but when used in combination, they can help you achieve your investment goals while navigating the market with confidence. Entering the world of the stock market often means encountering technical terms and financial jargon. Understanding this language is essential for beginners to make informed decisions and navigate the complexities of investing with confidence. Familiarizing yourself with common stock market terms and definitions is the first step in gaining fluency in financial language. Key terms include stock, ownership in a company represented by shares; market capitalization, the total value of a company's outstanding shares, calculated by multiplying the share price by the number of shares; dividend, a portion of a company's earnings distributed to shareholders; earnings per share, or EPS, a company's profit divided by its number of outstanding shares; PE ratio, price to earnings ratio, calculated by dividing a stock's price by its EPS used to assess its valuation; bull market, a period of rising stock prices and optimistic investor sentiment; bear market, a period of declining stock prices and pessimistic investor sentiment. Understanding these and other terms allows you to decipher financial reports, analyze company performance, and communicate effectively within the investment community. Interpreting stock market quotes is essential for monitoring investments and making trading decisions. A typical stock quote includes ticker symbol, unique abbreviation representing a company's stock; volume, number of shares traded during a specified period; bid and ask, the highest price buyers are willing to pay and the lowest price sellers are willing to accept; high and low, the highest and lowest prices the stock traded at during the trading day. By understanding these components, you can track stock performance, assess market liquidity, and execute trades effectively. Financial news outlets provide valuable insights into market trends, economic developments, and company-specific events. However, deciphering financial news requires discernment and critical thinking. You should consider the source's credibility, the context of the news, and potential biases. But not only these, do not use hearsay as your only basis. Also, understanding the implications of news events on stock prices and market perception is crucial for making informed investment decisions. In summary, mastering stock market vocabulary is important for beginners to navigate the web of investing successfully. By understanding common terms, reading stock market quotes, and interpreting financial news, you can improve your financial literacy and make informed decisions to achieve your investment goals. Once you've invested in the stock market, actively monitoring and managing your investments is crucial for optimizing returns and mitigating risks. Here are 3 key practices to help you stay on top of your investments. 1. Regularly monitoring your portfolio's performance allows you to assess how your investments are performing and whether they are aligned with your financial goals. Tracking key metrics such as overall return, individual stock performance, and portfolio diversification helps you identify strengths and weaknesses in your investment strategy. Utilizing investment tracking tools, spreadsheets, or portfolio management software can simplify this process and provide valuable insights into your investment performance over time. 2. Rebalancing your portfolio involves periodically adjusting your asset allocation to maintain your desired risk level and investment objectives. Over time, changes in market conditions or individual asset performance may cause your portfolio to drift from its target allocation. Rebalancing allows you to realign your portfolio by selling overperforming assets and buying underperforming ones to restore the desired balance. This ensures that your portfolio remains diversified and aligned with your investment strategy, reducing the risk of overexposure to any single asset class or sector. 3. Staying informed about market developments, economic trends, and company-specific news is essential for making informed investment decisions. Actively following financial news outlets, market analysts, and industry reports can provide valuable insights into market dynamics and potential investment opportunities or risks. Also, participating in investment forums, attending financial seminars, and networking with other investors can help you stay informed of market trends and exchange ideas with like-minded individuals. By incorporating these practices into your investment routine, you can effectively monitor and manage your investments, adapt to changing market conditions, and optimize your portfolio for long-term success. Remember that investing is a dynamic process, and regularly reviewing and adjusting your investment strategy is key to achieving your financial goals. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.